So here's a very important question. How do we fix the Fed? I mean, it's not about dot plots or monthly little point ones on the inflation report. Let us talk to a Fed veteran, Kevin Warsh, former Federal Reserve governor, now a visiting fellow at the Hoover Institution. If I'm not, are you still teaching at the business school?
Yes, sir.
There we go. I want to sneak that in there. So, Kevin, I just, you know, you saw today's action. I mean, they're only going to cut once, maybe. They're always, these dot plots, these forecasts are always incorrect. They were incorrect at the end of last year. Who's to say they're not going to still be incorrect? But are they watching the right thing in your judgment?
So in a word, no, they're not. And Amplify today, they effectively cut today. They effectively cut because they keep talking about how they're going to cut. They keep saying cuts are coming. They keep now going back to a version of quantitative easing. They're bringing liquidity to the market. Since December of last year, they've told the world they're cutting. So financial conditions are easier. Markets are looser. And so what's happened, Larry? Inflation's stopped falling. Inflation, if anything, is moving a little bit back up. So it's pretty good, I guess, if you own financial assets, but they're taking huge risks with hardworking Americans who are paying a higher inflation tax every day.
No, it's right. I mean, look at the opening segment, and we had two terribly, terribly smart people, but Taylor Riggs and John Carney. But the fact of the matter is, the 12-month inflation rate is still way above the Fed's target. It's 1.5 points above the Fed's target. But the more important thing is, over the course of Mr. Biden's term, the level of prices has gone up about 20%. We haven't seen anything like that in decades and decades, right? And it's killing them, and personal borrowing costs have gone up accordingly. So I would ask you, why is the Fed de facto or otherwise trying to put new liquidity into the system? I would think they'd want to be gradually tightening.
So I can't speak to motives, but they're goosing the economy when we're at full employment. They're goosing the economy when financial markets are about as hot as they've ever been. And they're somehow surprised that inflation is finding its way back into the system. That inflation dragon is always just below the surface. They needed to kill it. Instead, they're giving it some sustenance, and I worry that inflation is going to be a bigger risk, not just in the second half of the year, but next year, too.
Kevin Warsh, if you were back at the Fed as a governor or a vice chair or a chair, would you recommend different targets?
Yeah, I'd recommend a lot of different things, but frankly, Larry, they can't wait. They need to make changes in their policy right now because hardworking Americans are getting hurt.
But what would you recommend? Give me a for instance.
Let me give you
sink my little teeth into.
Let me give you 3 quick ones.
Yeah.
First, get rid of the dots. The dots are
right. Love that.
The dots are predicting things they can't predict.
Right.
They've been wrong, so it hurts their credibility. And their credibility is actually more important even than the printing press. And the dots where they say how many cuts they're going to have, that's spoon-feeding the markets. What you and I want to do is we want to get markets to inform policymakers. We want markets to tell us what's really happening, so we've clouded that whole thing. So that's number one. Number two is I would stop all of this forward guidance. I'd get rid of it entirely. Today, the chairman of the Fed spent about an hour in his press conference changing his views about this and that. All the Fed should say is, listen, if this happens to inflation, we're going to do X. If that happens to inflation, we're going to do Y. We don't need to talk about everything else.
No normal, average person working a job understands any of it. It's all government bureaucratic, Washington gibberish.
Yeah.
I mean, really.
I totally agree. I'll make
one more.
To make a third and final point. They've got to stop giving the incentives for Congress to spend a bunch of money we don't need on projects we don't need at the wrong time at the wrong price. Because the Fed's in this quantitative easing business where the Fed's buying treasury bonds, it's suppressing yields, and it's telling Congress, you can spend all the money you want. Well, there's a big bill to pay, and that's been facilitated by the Federal Reserve.
I just never understood this, Jay Powell, whom I know, whom you know. Why doesn't Jay Powell go to Congress and tell them to stop spending like Greenspan did and like Volcker did in our lifetime? How can they keep spending and the Fed not enable them and therefore conquer inflation? It doesn't work.
Well, I think it's a little worse than that even, Larry. He went to Congress and he said, please do spend. The big mistake you can make is if you don't spend enough to get us through the pandemic. And that led to this huge inflation surge That was a set of bad policies. We need a regime change with good policies that reward work, that deregulate the economy, that bring energy independence. And if we have those, we can have a stronger economy again.
And good appointees to the Fed. Kevin Warsh, thank you very much, buddy.
Thanks.